Morning everybody, welcome to today's morning market. So today I'm going to focus in on sovereign bonds, UK sovereign bonds, so what are known as UK gilts, where we've seen yields on the 10-year drop below 4%. But most importantly, what's our take on this? So maybe just before we discuss the actual moves in yields, what are UK gilts and how do moves in yields affect moves in gilt prices? So when we look at UK gilts, if you're a buyer of a UK gilt, you're actually lending money to the UK government in return for interest, and then at the end of a certain period of time, you get that money back overall. Now, UK gilt yields move inversely to UK gilt prices. So what do I mean by that? What I mean by that is when we talk about UK gilt yields coming down, which is exactly what I'm talking about today, that actually means that that's good for prices. That's good for the asset class overall. But what have we seen recently in respect of UK gilt yields overall? So as I said earlier, UK gilt prices have shown real strength with gilt yields falling below 4%. If we think of where we were in, say, mid-October time, 10-year UK gilts yields were around about 4.7%. So against this backdrop, you've seen significant moves in gilt prices upwards, which is favourable for you as an investor. But what's led to the moves? What's the kind of backdrop here? And what you saw last year was significant moves in interest rates to try and curb elevated levels of inflation. What did that mean for gilt yields? So if we go to the end of 2021, the 10-year UK gilts were yielding just under 1%. And if we look at where they peaked out around about the 4.7% level overall. But what's actually happened over recent weeks? So what's happened since that mid-October point? What you've seen is UK gilt yields fall from around 4.7% to just under 4% where we are today. Now, why is that? It's happening because investors are changing their expectations of where interest rates move to over the coming years. So what you're seeing now is that in the UK, 0.75% cuts in interest rates are priced for next year. And that's actually similar if we look at the US and we look at the Eurozone. So if we look at the US, you've got 5 interest rate cuts priced for next year. And the Eurozone actually has 6 interest rate cuts for next year overall. Now, what's our take on this? So our take on this is that UK gilts and actually all developed market sovereign bonds have experienced some real positive outsized moves recently. And all of that is driven around what's happening with the expectations for interest rates. And if we think around, what we've seen over, let's say, the last 5-6 weeks, where we've seen really decent returns come through from all major asset classes, that's a function of what we're seeing within interest rates right now and the expectations that we'll start to see interest rate cuts coming through next year rather than higher for longer, which was the original narrative that investors were focusing on. I hope you enjoyed my video today. Please do subscribe to our YouTube channel. Please do watch Morning Markets, our podcast, all of the information that we provide for you. And I look forward to speaking to you soon. Thank you.